Is the real estate market finally cooling off? Find out right now. Hey, if you're a homeowner and investor or interested in buying properties here in South Louisiana, we've got all the data that you need. Hi, I'm Jim Keaty with Keaty Real Estate, and this is your market update. Once again, we're off to another record-breaking year. So far this year, Lafayette has experienced a 13% increase in sales year over year. That's 81 more sales in January and February 2022 compared to the same time last year. With February 2022 reporting an 8% increase year over year with 351 sales, breaking the record set last February. As you can see in this next chart, when looking at February sales going all the way back to 2012, Lafayette Parish reported significantly more sales in February 2022 than any other February in the last decade, showing signs that demand is still climbing. Now this trend continues into total dollar volume sold. Lafayette Parish reported a 24% increase, breaking over $188 million in volume. That's an additional $36 million sold year over year. We are diving into supply and demand. Lafayette Parish reported 11% fewer new listings February 22 versus February 21. However, the MLS reported a 24% decrease in the total actives available. So what we're seeing is slightly fewer new listings coming onto the market as last year, but the demand is absorbing the inventory faster than the homes are becoming available. And that is leading to a lack of supply. So demand is driving the lack of supply in the inventory, not necessarily lack of sellers listing their properties. Because of this lack of supply, our days on the market has decreased from 58 days last February to 29 days. This is an indication of a seller's market. Buyers are competing for those homes. Here is another very interesting trend. The average showing to pending ratio going back to 2014 was 5.5%, meaning it took on average 16 showings to sell a house. As inventory started to decline in 2020, you can see the showing to pending ratio significantly increased to 16%, meaning it only took 6 showings to get a house sold. That is a 60% increase in the showing to pending ratio year over year. So real estate prices are a function of supply and demand, and months of inventory is how we keep a pulse on what's happening with our supply and demand. Looking at our inventory going all the way back to 2012, you can see we have hovered around the 5 and 6 months of inventory, which would be considered a balanced market. Starting in 2020, we've experienced well below average inventory levels and have reported inventory levels to be under 5 months of inventory. This lack of inventory has created a seller's market, and the average price in February 2022 has increased from $246,000 to $269,000. That's a 9% increase year over year. So where are we going? Well, I'm glad you asked. Going all the way back to 2012, we've experienced a moderate appreciation of 3%. This is well below the national average at 4.14%. So I do not believe that we're in a bubble. Actually, with the impact of inflation, the experts believe that prices will most likely continue to rise over the next few years and beyond. As an example, if we continue to experience appreciation at 3% over the next 20 years, our average price will be $485,000. But if we follow the national average appreciation in 2044, our average price will be over $600,000. Let's take a look at this next graph from the Home Price Expectation Survey. I think it gives you a very good picture as to where home prices will be according to the experts. So what we're looking at is the most optimistic experts say that we could see a 62.5% appreciation by 2026. The pessimists, the ones who think it's going to grow at the lowest rate, say 23.7%. And when we average out all of the predictions, we get a 43.3% appreciation by 2026. So as you can see, all signs point to prices continuing to rise in the long term. Homeownership is really a hedge against inflation because, as you can see in this slide, over the past 5 decades, home prices have always increased faster than inflation. That means someone buying a home today can lock in today's costs, protect themselves against the rising cost of inflation, and lock in that monthly low payment going forward. So it becomes mission critical for renters to understand this dynamic of buying now if they can. Renters take on an additional risk by waiting to buy. Most experts are forecasting higher interest rates, higher home values, and if you look at the rental market going all the way back to 1988, rent has only continued to increase with no signs of that slowing down. So at the end of the day, waiting to buy will cost you much more money. Lafayette Parish has experienced a 1.3% increase in pending sales in February year over year. So it looks like, although we've had record-breaking January in closings and volume, the pendings seem to have cooled off, meaning we should start to expect the same or slightly fewer closings in the next 30 to 60 days as compared to last year. However, when you're looking at the number of pendings for February going all the way back to 2012, you can see in this slide that we are well above the average number of pendings for February, indicating we should expect an outstanding first quarter. And although pendings have cooled, demand continues to hold strong, and in fact, the MLS reported that over 19% of the homes sold in February sold above list price. This is double the average over the last decade, indicating a very strong demand for housing and a short supply of homes for sale. And as always, we like to keep an eye on what's happening with the interest rates. Now, in order to predict where the interest rates will go, you have to look back at the 10-year Treasury yield. Although the Fed does not directly control interest rates, they do control the 10-year Treasury yield. Now, by raising or lowering the Treasury yield, they hope to influence the interest rates. In other words, the Treasury yield and interest rates have a symbiotic relationship. When the Treasury yield goes up, so does the interest rates. And you can see in this chart that the 10-year Treasury yield has skyrocketed in the last 3 months from 1.43 on December 1st, 2021 to 1.81 on February 1st. So we can expect interest rates to follow. In this chart, you can really see the relationship between the mortgage rate and the 10-year Treasury yield over the last 50 years, going back to the 1970s. Over the last 5 decades, the average spread between the 10-year Treasury yield and interest rates is around 1.7. We also look to the experts. We average the predictions of Fannie Mae, Freddie Mac, and the Mortgage Broker Association, and the National Association of Realtors to come up with what to expect moving forward. And as you can see, we expect the rates to increase to above 4% in the fourth quarter of 2022. Is this bad? Sometimes we need some perspective. Looking back at the last 5 decades, you can see there's never been a better time to buy than now. But we do expect interest rates to rise. I hope you found this information valuable. If you are interested in buying or selling real estate, I would love to help. Stay tuned for next week when I'm going to break down March sales and volume. I'm Jim Keaty with Keaty Real Estate. Thanks for watching.